Hello everyone, this is Matthew Frailey with BreakpointTrades.com. This is the comprehensive Breakpoint Trades market newsletter for Sunday, March 3rd, 2019. I'm doing a different format this weekend, posting it on YouTube, something different. As you know, our newsletters are typically audio based with static charts. That's what you're mostly used to. Again, this weekend I'm doing a video, so hopefully you appreciate the format differently, and I can also point out things that I can't easily just talk about. Okay, so let's get started. If you happen to be new here, again, Breakpoint Trades has been around for quite a long time, since 2003. That's when I started it. These weekend newsletters tend to be very comprehensive, anywhere from 80 to 100 charts, usually an hour long. Again, that's the weekend newsletters. The intra-week newsletters are shorter time, maybe 20 to 30 minutes. But we cover on the weekend, we cover the general market in great detail, from weekly, monthly charts to daily, intraday time frames. We look at various market sectors, bonds, market indicators. We look at commodities, precious metals, and education. Okay, so let's go ahead and get started here. So here's just a brief table of contents of this newsletter. Again, first off, we talk about the general economic news from last week, what happened and what's coming up. We review the major indexes. That's the Dow, S&P, Nasdaq, Russell 2000. We look at the monthly, weekly, daily, and intraday time frame with a major focus on the S&P 500. Do an in-depth look at various market sectors, bonds, economic indicators, sectors, commodities, precious metals. Let's first look at what happened last week. Again, this is what our general market newsletter looks like with the audio, but again, I'm doing video this week. So here's the index sector table and what transpired on Friday last week and for the week. The market did have a pullback last week from Tuesday to Thursday. Then it had a big rally on Friday, as you can see here, at least a decent rally. Again, the market, did consolidate from Monday. On Monday, I pointed out the doji black candlesticks on the major indexes. Major indexes were at major resistance areas. We did pull back for 3 days, and then, of course, we rallied once again on Friday. The market continues this relentlessly strong uptrend, as I'll discuss below. Is it getting tired? I believe so, but the trend has been strongly up since late December. Anyway, you can see for the week, the major indexes mostly ended up, except for the Dow, which was just slightly down. Again, it recovered a lot of its losses. And for the Russell 2000, the S&P ended up 0.4%, which is our benchmark, and the Nasdaq ended up 0.9%. Again, a lot of these gains occurred on Friday. As far as the major market sectors for the week, sort of a 50-50 mixed bag here. But by far the weakest sector last week were the gold stocks, down 5.9%. That's GDX. Remember, the gold stocks were leading for a few weeks. We had a lot of precious metal stocks on our trade watch list, which did very well. But 2 weeks ago, we pointed out MACD divergence, spinning top doji candlesticks. We said, hey guys, time to take profits, look for a pullback. And that's what's been happening since. GDX had a really nice pullback last week, as did gold metal. You can see metals and mining down 2.3%. Home builders finally also pulling back. That's been a very, very strong sector, as has real estate. So not surprised to see some pullbacks there. Last week, strength in retail up 2.25% basically. Energy holding up well, up anywhere from 1 to 0.7%. Banks and financials. Transports, though, have been weak. They were quite overbought. Market rally was getting quite tired, divergence building, so not surprised to see a 1.25% pullback there. Biotech stood out to the most of the upside last week, up 4.3%. Currency-wise, we generally focus on the dollar. It was slightly up for the week. A lot of the gains occurred on Friday. And as far as commodities, as you'd expect, A lot of commodities been selling off here. Natural gas has been the outlier, up another 4.4%. Natural gas put in a nice falling wedge about 2 weeks ago, which we pointed out, and it's been a really nice long trade. So congrats to anyone who went into that. You could have bought UNG or the UGAS triple long ETF. It's been a nice trade, but most other commodities have been down. Crude oil down 2.5% for the week. Copper down 0.6, though longer term that chart looks fine. DBA has been commodities. I mean the agriculture sector has been pummeled. DBA down 1.85%, made new lows last week. Wheat down 7%, coffee down 3%, sugar down 4.25%. Though we did see some reversals on Friday, I'll be paying attention to those. Precious metals, again, gold down 2.9%, silver down 5%, so that's a big pullback. GDX down 5.9%, that's the stocks, as I stated above. And as far as bonds, high yield corporate bonds continue to have this amazing strength. They pretty much had a vertical V rally during the whole time up. So up another 0.5% last week. Now TLT, 20-year bonds have been falling. They had a triangle pattern, which I'll show below when we get to that, down 2.4% last week. So they started breaking early in the week and had a nice follow-through sell-off. As far as major economic news, here's a list of that. I apologize, for some reason this image here is a little bit it's not really clear for some reason, but obviously the big one next week is the non-farm job payroll report on Friday. That comes the first Friday of every month except for February. So that's the big one here. And we're mostly through earnings season, though I would still continue to check earnings for stocks that are trading. Okay. All right, let's go ahead and move to the charts. So this first image here, this is from Zero Hedge. Someone sent it to me, but I just wanted to show this. Why is the market had this absolutely relentless rally from late December? Well, remember, guys, part of it is just money supply. Okay, central banks, which were tightening last year, especially our Fed, they reversed course, and you can see the global money supply here started ramping up. Yes, there was a little lag effect. Market that started ramping up here in late November last year. Market fell in December, but obviously there's a lag effect. But again, remember, guys, money supply or liquidity is basically what drives the markets. When there's excess liquidity, it finds its way into the markets and drives things up. Really, that's what has really been dominating the market for quite a while here, especially since all the quantitative easing and all the excess central bank manipulation has been occurring in the last 10 years. Okay, so that's a big reason why. Had we not had this, I strongly believe the market would have been in some more of an extended bear market instead of this, V rally up that we've had, or we would have rallied up a little bit and then retested the lows for a better low, sometime this year and then rallied up. But, hey, money supply liquidity is king. Always remember that. Next, let's move to the charts. So the first chart we like to show is a monthly chart of the major indexes, the Dow, S&P, Nasdaq, Russell 2000 at the bottom. So again, quite a lot of volatility last year. As you know, we had a parabolic blow off top, parabolic move in January. We had that big correction in February, March. We rallied up again, made minor new highs last fall, then had another gut-wrenching correction. A lot of volatility. We expected last year to be volatile, and boy, was it ever. 2017 was the least volatile year in 100 plus years, and after that, big volatility follows, and that's what occurred in 2018. Anyway, we've had a near vertical rally up. If you look here, the Dow, a lot of the indexes were up anywhere from 7 to all the way 11% in January. For February, the indexes were up anywhere from 3% to 5%. So a lot of gains here. They still haven't recovered and taken out the fall highs from last year, but they're not too far away. I'll say the Nasdaq 100 and Russell are the furthest away, where the Dow is the closest. Next, chart shows a weekly chart of the major indexes. Again, you can see, the weekly here, the big, basically ABC correction we had last year, and it was a zigzag. Okay. Now, we were expecting a decent rally after the December 26th lows, but honestly, it went more vertical and more of a V than I thought it would. I was expecting major indexes to go up around the 61.8% fib, maybe a little bit higher, maybe to the 200-day moving average. So that's about right in here. But, the indexes, this rally has surprised even me. So again, we did expect a decent rally, but boy, you know, it's been even more than we thought. And I think that's for a lot of people. So far, we've had 9 consecutive up weeks. Last week, finally, little down week or a consolidation week. You can see the Dow was slightly down. S&P formed a doji. Same for the Nasdaq, NDX 100, and Russell 2000. In particular, I'd like to point out the doji candlesticks this week. I think, again, after such a strong rally, and again, we've been saying this for a while, but clearly market will pull back here sometime, guys. It's not just going to go V up forever, okay? This is, under the very bullish case, this is a wave 1. We'll eventually get a wave 2 pullback, which would likely be a 38% retracement of the move up. So eventually that is occurring. The longer we go up, the odds increase of that occurring in the short term. Every time we get a doji candlestick, you always want to keep an eye on, because a lot of times these dojis precede pullbacks, just like you see here, etc. Okay, next. This image shows a daily view of the major indexes. Again, we had the ABC correction last year, bottomed on December 26th. Then except for a one-day little pullback there in early January, it's pretty much been a straight up move with the major indexes pretty much staying above their 9 EMAs almost the whole month. Except for a day or so, pretty much consecutive closes the whole way up. Last Monday when I did the newsletter, I pointed out these black candle doji candlesticks here, which you see on my comments. And again, those black candle dojis usually mark some kind of, at least some type of short-term high or low. And it did, but so far all we did is get a 3-day pullback, held the 9 EMA, and then bounced on Friday. So we continue to hold this 9 EMA. The way the intraday charts look, it still looks like maybe we still want to push a little higher here, but we'll see how things open on Monday. But again, now we have doji candlesticks on the weekly time frame. Next, moving on to the S&P 500 charts. Here's a weekly view, or a monthly view, I mean. So again, the fact that we had a decent correction last fall, not surprised. We made that minor new high push in the September time frame. We had big divergence on the RSI indicators, even some on the MACD. Everyone was looking for a correction. We were looking for a correction, possibly a bear market. And we got a hell of a correction. And so far, we've had a hell of a rally back up. Okay. I will say on this chart, and I think it's pretty obvious, generally on a monthly chart, guys, there's a lot of things we like to look at. When you get divergence on the RSI indicators, that's something to take notice, and the MACD. But generally, the monthly MACD is a pretty good trending guide. Again, it's not perfect on the S&P, as you can see here, but it's been a pretty good guide about catching most of the major trends. Again, once in a while, you get a little whipsaw like back here in 2011, where it crossed briefly, then came back up. Now, I think that one could have been filtered out simply because you had just come off of a major bear market bottom in 2009. So that was only a year and a half after the odds of a bear market occurring then was very low. Actually, 2 years, I'm sorry. But, we had a MACD cross back here in 2015, and that led at least for about a year mini bear market. Then we had another move up. MACD crossed last fall, and that's produced a healthy pullback. But one thing that's pretty obvious, what I'm getting to, despite the big rally up here, look how much this MACD is lagging. Look how far the MACD is away from its signal line. It's still going to take a long time for the MACD to ultimately cross up over that. As you can see, it's probably going to be many months still before the MACD were to cross up. So if the market does rally here to new highs, you're going to have a really nice MACD divergence here now. Okay. Next, chart number. This chart shows another monthly view of the S&P. Now on this chart, I took away price and I just have the moving averages. Here I'm using an 8 and 13 exponential moving averages. And you can see overall that's been a pretty good guide. It's not perfect. It's going to miss the tops. It's going to miss the bottoms. It's basically going to catch, maybe 80-85% of the major trends. But you can see here, the 8 EMA crossed below the 13 EMA back there in late 2000. Remember, the market topped in March 2000, so missed that top. It then crossed back up in mid 2003. It crossed down in early 2008. So again, it missed the top, but still a decent cross. And then it crossed back up in later 2009. And you can see during this whole 10-year bull market, the 8 EMA has really never crossed below the 13 EMA. Here it got really close, was basically touching, but still rebounded. And even here last year it didn't cross. Okay, so that's definitely something to monitor over time. Next, this chart shows a weekly view of the S&P. In December, we fell all the way to the 200-week moving average. That's the green moving average here, which tends to be a long-term support and resistance, and obviously held as support. You could of course see the V rally. We had nice RSI divergence on the weekly time frame, so that led to a decent rally, but obviously we've had a fairly V rally up here. When you really look at the market on the monthly and weekly time frames, you can see how vertical V-ish these rallies are. That's why, under a very bullish condition for the market, the healthy thing would be for a pullback consolidation here sometime soon. It's not healthy for markets just to go straight up. Obviously, we are overbought. We've been overbought for a while. Now the 5 RSI is 77% on the weekly. Next, here's another weekly chart. Zoomed in a little bit. This contains the moving average ribbon that I like to use. This is a really nice guide, guys. When the moving averages, the way they're laid out here, the 9 EMA is in pink magenta, then the 20, 34, and 50. Okay, so obviously when the 9 is above all these, they're bullishly stacked. And I like to look for low risk longs whenever the moving averages pinch together, like here. Okay, on this consolidation. Market had that big rally in 2017. You really didn't get any pinching on the moving averages. You then did get a little bit early last year after that first correction. That led to a decent rally. Then the moving average ribbon went bearishly configured here. And despite the whole rally, it's still not really bullishly stacked. The 9 EMA is slightly over the moving average, as you can see, but it's in an area where it could easily turn back down too. Okay, so something to keep an eye on. Again, this weekly chart, you can see the V rally we've had. What really stands out is the doji candlestick last week. Okay. Now, one thing to point out, Steve talked about this last week, is the 78.6 fib. Okay, that's at 28.15. We almost hit that last week. We hit 28.13.49. I'd say that's close enough for government work. That was a target. That's 78.6 fib. We almost tagged that last week. The 61.8% fib is another, that's the major one, but that was of course taken out a few weeks ago. That was back here. So this is the next fib area where the market, to look at where the market could pause. Okay. Next, move to the daily charts. So again, this daily chart shows a bunch of our indicators and of course the moving average ribbon. Again, you can see when the moving average ribbon is stacked. You can see here it went positive. Nice pullback where the moving average is pinched. That was a nice long last year in the June time frame. Moving average then went bearish. They flipped bearish here. We had that correction in October, November, December. And you can see every time the moving averages started pinching during that time frame, provided great shorts. Right here was a great short. You had a doji candlestick that provided a trigger, which was the low of this candle, with a stop at the high. Very low risk. Market sold off, bounced back. You had another example right here. Could have triggered short there. Again, you can clearly a great example. Market in that big flush down in December. As you can see, now whenever the moving averages then get very, very wide like this, was also why I was not surprised to see the market not provide another short here and then sell off again, because they were very wide. So you can see basically reversion to mean. Things are just too stretched, oversold. So once the market started rallying up, it continued. Moving averages, they never really pinched here. They didn't stop. It kept going, and you can see that's bullishly stacked. And we've had this relentless uptrend since. Took out this downtrend line, had a little bull pennant here, continued higher. Last week we had a pullback, but held at 9 EMA once again. So if we were to get another rally here early this week, I'd be targeting this resistance area around the 28.15. That's the 78.6 fib. I do believe, guys, we are getting close to something. Again, I know we've been saying that for a while, but the longer we go up here, the riskier it does get for short-term longs. Okay, we're eventually going to get a decent pullback here. Okay, this is the current resistance here I'm monitoring, and of course the 9 EMA. On a good break of the 9 EMA here, the 20 EMA would be your next target. Next, here's another daily view. This has a bunch of moving averages. Obviously, we're over all the moving averages. So, long-term supports now this lower downtrend line. Next, here's another daily chart, just a very clean chart. This one focuses on the 9 EMA, which we've mostly held during the entire uptrend on a closing basis, basically. So the only time we were below the 9 EMA here was early January. And every move up here was above the 9 EMA. This one, even this, again, you were below the 9 EMA on these bars, but you closed back above it. So the whole time that 9 EMA has been holding since early January. I think that's January 3rd. Okay, so that's your critical short-term support. A close below the 9 EMA would represent a symmetry change and the start of maybe finally a correction. Again, you can see the MACD is flattening out here. So momentum is waning, and we could form some divergence here, especially if we take out this little high in the short term. Okay. Next, here's the daily pivots charts. These are always good guides for support and resistance. We're stuck around this pivot here. The next pivot, of course, is 28.35. So if the market had another big ramp up, that could be a target possibly as well. Next, here's another chart of the S&P daily view. Again, guys, we're eventually going to have, under a very bullish case where this is a new wave 1 uptrend of a bull market, we'll eventually have an ABC pullback for a wave 2, something like this. Okay. Generally, wave 2s are about 38% retrace of wave 1. So honestly, if you're longer term and you're not long as much as you want, it'd be best to look at some sort of pullback like that to get more aggressive on longs instead of chasing up here. Okay, and I know you say that, well, hey, I could have bought last week or a week before, and that's true, but again, this is your more objective entry for bigger swing ideas. Up in here, longs I view as more short term until we get that nice correction. Again, we might not correct until higher prices. Maybe we go higher first. Okay. You could also see what could be a big inverse head and shoulder pattern. Notice you could almost draw a neckline here. This would be a left shoulder, that could be a head, and this could be a right shoulder. For a proper right shoulder, you need a pullback, something like this, that would be symmetrical with the left shoulder. Okay. Again, is it possible that this is still some sort of huge bear market rally that comes down again? It is possible, but otherwise that is more improbable at this point. Next. Actually, I don't want to discuss this image next. Let's move back to this one. Let's go to the BPT MA Deluxe. This is another daily view of the S&P with a lot of our custom indicators like the BPT MA Deluxe, which is a custom trending moving average. And again, that's been a pretty good guide. It's been green since January 3rd here, so it's done a good guide of catching this entire uptrend, pretty much. We can monitor that on a pullback. The big support area though, besides the 9-day exponential moving average, I'll be monitoring this simple ATR trailing stop. Again, that's a common indicator that you can use on most of your charting platforms. Anyway, let's talk about just an education thing. And I talked about this last week, guys, but I'm going to recover it here since I'm doing a video. So again, this is a very, very simple guide, but sometimes simple is best, and things like this can really help you. So what I'm doing here is, the parallel lines here, these are supposed to represent the 9 and 20 moving averages. Okay, I know moving averages don't move straight like this, but I made this image quickly, last week during the market, so I didn't have time to make them look like a moving average. So think of these horizontal lines as the 9 and 20 moving averages. Okay, you could pause the audio here and make sure to read what I'm talking about, but basically what I'm talking about here is whenever the slope of the 9 and 20 moving averages are very steep like this, when you get pullbacks, they tend to be very quick and bounce right back, kind of like this. Boom, right, bounce back, boom, bounce back. I bring this up because I know some of you have been trying to pick some tops, quick shorts, and I've done it as well. But when the moving averages are very strongly sloped like this at 45-degree angles, whenever you have let's say you're short and then the next morning you come in and the market is down, be very liberal about taking profits, because most of the time it'll come right back and you can just reestablish a short when you see another trigger. The problem what a lot of us get stuck in is we're like, all right, we know the market's overbought, we know it's due for a pullback, so we want to catch that exact top and then hold it. But I'm telling you, when the slope is like this, be more aggressive about taking those profits, because many times you get profits and then they just evaporate, and maybe you end up taking a losing trade, and it happens over and over again, and it gets on your psychology. Okay, whenever the moving average slope starts to flatten out a little bit, shorts can work a little bit better. When it's like this, sometimes you only get a half a day pullback and it comes right back. Many of you have noticed that. When they're a little flatter, maybe they start working a little better, last a couple days, and they really start flattening out. Those work even best. And of course, flat, that's when you get your bigger corrections. Right now, the moving average slope, I think, is probably more like around this time frame. Around January, February, it was like this. Obviously, momentum's waning right now, but it's more kind of like these. We're not anywhere like this where the moving averages have flattened. That's when you get your big corrections. That's kind of like we had last fall. Okay, when those moving averages flatten, that's when you get your bigger moves and when you can let your shorts run for bigger swings. Rarely do you get something like this where the moving average slope is 45-degree angle and you get your big correction like this. Only in, say, parabolic blow off tops do you get something like that. So I hope that makes sense, but it's just a nice guide to go over. So let me show you a real example. So here's a daily view of the S&P. This has the 9 and 20 moving average on it. Now I use the 9 EMA and the 20 SMA here. Here I have the S&P invisible, so you only see the moving averages. But you could see, back there in January and February, these moving averages were basically vertical, 45-degree angle. So shorting just does not work well during that time frame. You can see back here the moving averages, yeah, we were going up, but they had flattened out a lot, right? Now, since the market's been so strong here, they are starting to, I would say the momentum's waning here a bit. But again, in this time frame, when they're that 45-degree angle, be careful shorting, and when you do, just be very liberal about taking profits because you get those snapbacks. Okay, so review this image with the previous one. Okay, next let's move to the intraday charts. Here's a 2-hour view of the S&P. This is a nice guide. On the 2-hour charts, I like to use the 20 and 50 EMAs. So we put that bottom on December 26th, rally up, pulled back, formed a bull pennant there, rallied up. This is another bull pennant here. This is a falling wedge, actually. That's a bull pennant. And you can see this just nice progression. MACD is every time it's recycled back to zero. You've had rallies. In fact, last week it recycled back to zero. Here we got a horizontal rectangle pattern. So when I'm watching to see if we take out that 28.13 high again, if we sell off and break this, then a correction's finally probably starting to occur. Okay. Now, here's the thing, guys. We talk about symmetry. The largest pullback in this uptrend has been about 62 points. We had a 62-point pullback here and a 57-point pullback. So, if the next pullback exceeds this, that'll tell us for sure that we're starting that decent ABC correction that I talked about above. Now, if we do make a new high this week, I will be watching for some MACD divergence here. Okay. Next. Here's another 2-hour view with the moving average ribbon that I like to use. Again, you can see every time that moving average ribbon is pinched, you can see that corresponded with this pennant here. That provided a great long trade. Same way here. Nice long trade with that moving average ribbon. Even last week, the moving average ribbon was pinching again. Okay. This shows you a wave count, wave 1, 2, 3, 4. It appears we're working on a wave 5. Is it possible we put in a wave 5 here last week? It is. Or we could maybe put in a wave 5 should we push a little higher this coming week. Next, this chart shows a 60-minute view with the moving average ribbon. Again, every time these moving average ribbons pinch, provided nice long opportunities. Okay, see that? And moving average ribbon was pinching last week on this time frame. You can see this triangle pattern that's formed. So we'll see if we busted the upside or not early this week. Okay. Another thing that's been working is the 60 stochastic at the bottom. That's held over 50% basically this entire time. Yeah, it had a little brief stint below there, but a little brief 1-bar move and back up is not what I consider a sell signal. That's another education guide, a 60 stochastic. The 50% area tends to be a dividing line between uptrends and downtrends. It's very simple, but it works quite well. I've back tested that on strategies and it works well. Next, here's a 15-minute view. Again, you can see S&P was downtrending last week after Monday's doji candlestick, which on the daily chart we then gapped up on Friday, pulled all the way back, held this support. The broken trend line became support, and we rallied up late in the day. Here again, we have a downtrend line to monitor, and we'll see how we open on Monday. Next, moving to the other major indexes. Here's a weekly view of the Dow. Dow, you can see, was one of the major indexes that closed down last week. It looks quite tired here with that candle. Next, here's a daily view of the Dow. The Dow rallied right off that big support area I was pointing out in December. That was a pretty good catch by me, I think. Again, vertical rally just like on the S&P. Here you got resistance here. Can we take that out or not? Or was last Monday's highs a short-term top? We'll see. Next, here's another daily view, just a zoomed in view. Zoom in on that resistance area at 26,250. The 9 EMA is your current major support here. Breaking that would likely start some sort of pullback, at least the 20. Okay. That's another simple guide, guys. Whenever the 9 has held for a long time, when you break it on a closing basis, you'll always test the 20 moving average. Next, here's a 60-minute view of the Dow. And on the 60-minute view of the Dow, I can argue a decent rising wedge that completed 5-wave pattern. You can see the MACD divergence. So again, it's possible that this doesn't go back and make another high, whereas the S&P is closer. So it's possible, and the Dow is lagging here a bit. We'll see. If a little wave 5 high is put in, then last week on Monday would have been a little short-term high, and maybe we finally start that ABC correction I talked about above. Next, here's IWM Russell 2000. Here I added the 76.8 fib. That's still up there at 126.40. Russell's lagged here versus the other indexes, which are basically up at that. You can see the black candle doji last week. Next, here's a daily view. Again, it's basically been holding the 9 EMA this whole time. That's your short-term support. Next, here's a 60-minute view. Just like the Dow, it's not really close to taking out last Monday's high. So again, while the S&P is just a stone throw away, it is possible that last Monday did put in a short-term high. We'll see. Next, here's the triple Qs, just like the other indexes. Been strong, though it did have one close below the 9 EMA, unlike all the other major indexes, which have been above it the whole time. Now this one got pretty close to taking out at Monday's highs. The 78.6 fib is up here. Next, here's a 60-minute view. Now the 60-minute view of the triple Qs doesn't look bad here. Definitely looks like a textbook ascending triangle that could have another pop here. Now another pop, it could form MACD divergence. We'll be keeping an eye on that. All right, so that does it for the major indexes, guys. An indicator here just to look at. I got this from Zero Hedge. So this shows the Nasdaq weekly winning streak. And you can see here, it's basically equivalent to what we've seen in early 2000. Remember, March 2000 was the high of that tech bull market. So this shows you how stretched we are in the short term. Clearly, market is getting tired, and we're going to have a correction here sometime in the short term. So guys, any longs should be shorter term at this point. Next, here's the chart of the VIX. Always a good guide to monitor. VIX has continued to melt down with the market rally. Now, the lower Bollinger Bands has generally been a support for the VIX. Last year, every time it tagged the VIX, the lower Bollinger Band, the VIX rallied and the market had pullbacks. Okay. Here in February, the VIX tagged the lower Bollinger Band, and it did bounce off there, but again, it only led to a couple-day pullback in the market, and then the VIX then stopped at the middle Bollinger Bands. But it's now back to the lower Bollinger Bands. That has my attention. So that's an area where the VIX could bounce and the market sell off. So guys, I think we're really close here. I think it's possible we put in a high last Friday, or if we get one more minor push early this week, I'd be really cautious on that market with the VIX down here at the lower Bollinger Bands. Okay. Next, this chart shows a comparison chart of the S&P 500 advanced decline line to the S&P small cap advanced decline. And what you want to look for here is divergences. Whenever the divergence forms, that tells you to be cautious. So back here, the S&P advanced decline had made a higher high. The small cap made a lower high. That led to that major top back in September. Same thing back here in December. Well, look, now we have a divergence with the S&P large cap and the small cap. So that's telling you to be really cautious here. This doesn't tell you when the pullback will occur, but when that divergence is there, it's usually, within a few weeks. So be cautious with this. Next, this chart shows the breadth thrust indicator. This occurred in early January, which actually worked out pretty well. That's when the breadth thrust moves from below 0.3 or below 0.4 all the way over 0.62 within 10 days, and it clearly did that. It is diverging here now, though. Next, here's a Renko chart of the S&P BPSPX. So it's a nice Renko chart. It's very clean. I use a 1-point box size. So this is sort of a mechanical-like system. It's not perfect, but it's a pretty good trending guide. You can see it signal to buy signal on December 28th there, whenever the MACDs crossed and you had a parabolic SAR buy with the Renko. And by the way, SSO was trading at 91.50 then. SSO is now trading at 115. So that was a hell of a percentage move. Been help on this buy signal. This was a great sell signal. SSO was 107 there, triggered on December 6th. So from December 6th down to here was a good short signal. Now these here were whipsaws, as you can see. They were minor whipsaws, but they were. This was a nice sell signal, triggered on a sell on October 4th. SSO was 126. Again, you can use any S&P ETF. I'm just using SSO. And all the way down to 109 when it triggered a buy signal. So that was a good short. So, a couple whipsaws here, but a nice short here, and nice long. So that's something to keep an eye on, guys. Next, This chart shows the NAHL, Nasdaq new high, new lows, plotted as a cumulative graph. This gave a great sell signal back in early October when it crossed below the 50 EMA. Again, it's generally a good guide for bear markets. You can see back when it crossed in 2015. Now this still hasn't crossed back over its 50 EMA. Okay, so despite this big V rally, it hasn't done that. This tends to be better at sell signals than it does buy signals. It tends to be kind of late on buy signals. Kind of like back here, it didn't cross. Well, it crossed back here, wasn't too bad. But it shows you how vertical this rally has been. Next, here's another chart. This shows the Nasdaq McClellan with a 2 and 5 EMA. Whenever the crosses occur, they can give you signals. Again, not perfect by any means, but something to monitor. Obviously, nowhere near giving a sell yet. Next, here's another summation indicator. This one went on a sell signal back here, and this is back over the 34. Next, here's the triple Qs with the NASI indicator. And here I'm using the 0 area for buy signals. This one on a buy signal back in late January. And what I mean by confirmed is I like to see it cross the 0 area where it was right here and then have a confirming candle confirm that. That filters out a lot of false signals, kind of like these. You could have filtered many of these out, like when this cross below 0 here was on this candle, you didn't get a close below it. So you filtered that short out, you filtered this one out. This one, of course, was confirmed. So that's a way to filter out a lot of false signals with that. Next, moving to bonds. Here's TLT 20-year bonds. Big sell-off, down 2.2% for the week. Not surprised, guys. Remember, I do believe long-term rates are going up. Okay? When bonds go down, rates go up. Next, here's the daily view. As I stated, TLT broke down from a triangle pattern early last week. You could see that, so you could have triggered short on this break. So nice sell-off from that coil pattern. Next, high yield corporate bonds. This has been vertical, straight up vertical. Look at this move. Crazy. It is diverging here with the MACD, but remember, divergence is not a sell signal on its own. You need some sort of trigger. And that's one thing that has helped prop the market, is the move up in these high yield corporate markets. Next, here's a comparison chart of the S&P to the high yield corporate bonds. I need to update this chart. Some of this got shifted. I apologize for that. But generally, when you get divergences here, is something to pay attention to. And, you know, the high yield corporate bonds have definitely been much stronger than the S&P, which have been help pulling it up. Next, here's the yield curve. You hear about that in the news. Move that over. It's going to be, when this goes below 1, it's what you call negative. It's still obviously still ways below doing that. But it's still stuck in this area that we need to keep an eye on it this year. Okay. Oops, sorry about that. Next. Here's a 10-year treasury yield, a weekly view. Again, with TLT down, rates were up. And finally, here's the big 40-year chart of the 10-year treasury yield. As I stated, I think long-term rates will go up over time. Rates have been in decline since 1981, as you can see here. It was a secular bull market. We had a double bottom in 2016. We finally took out this 31-year channel line, and I expect it to hold and rates to go higher over time. Okay. Next, let's look at some economic indicators with this week. Remember, on Friday we have the jobs report, so definitely got to keep an eye on some of these economic reports. Here's the unemployment rate. Again, it's been declining since 2010. What I found is a 5 and 9 EMA have been a good guide for trends. You can see when the 5 crosses over the 9 EMA back here in 2007, that signaled that the unemployment rate was going to go up, and it did. Same way here, decline in 2004, a rise in 2001, a decline in 1993. See how well these simple 5 and 9 exponential moving averages have worked, as well as the ROC indicator here when it crosses above or below 0. Well, look what you got here, guys. The 5 is pinching here with the 9 EMA. It's not a good cross yet, but it's definitely something that has my attention, a flexion area. The ROC indicator is nearing zero, and you have a divergence on the PPO indicator, which is the same as a MACD. I just like to use that on a larger time frame. So definitely something to keep an eye on. If we start to see a reversal, an uptrend in this area, that would signal the economy is starting to weaken. Next, here's the unemployment rate with the 10 EMA. You can see we've had a nice close above it. We had a minor close above it back in here, but this is the biggest close we've had in a while. You can see this has been a good guide. Next, here's the unemployment claims, and here the 5 and 9 EMAs have definitely crossed to the upside. So that has my attention. And here's the PPI, that's the Consumer Price Index inflation. It's been moving down. Now, again, it's possible that some of these indicators have moved up because of the government shutdown that we had late last year and early in the month of January. But we need to see these start to reverse up. If these continue to move, then we could be seeing some initial weakening of the economy. So definitely something to keep an eye on in the longer term. Next, moving on to market sectors here. We like to review the major sectors. So here's the transports. They've had a V-up move in the market, but they look quite weak, a week and a half ago, and they've pulled back now to the 20. Again, you can see my comments before, guys. When that 9 EMA was finally broken, it led to at least a test of the 20. That's what I expect on the major indexes if we lose the 9 EMAs. Next, here's the banks. Still uptrending, but there's divergence. Big resistance area approaching here. That was major support below, became resistance, so it's now resistance to monitor. Next, here's financials, XLF, still uptrending now. Next, XLK technology, just like the triple Qs, but very strong, still holding the 9 EMA, but again, monitor now, some RSI divergence. Here's the semiconductors. They pulled back early last week. They were quite overbought. We were expecting that. Real estate, this had a vertical rally in January and February. Look at that, taking out the highs from last year. But this had divergence on the MACD, RSI, so finally that's pulling back. Now here you have the 9 and 20 MA squeeze. So we'll see if we find some support on that. If not, this is now your support. Next, home builders. Not quite as nice recovery as real estate, but nice move up. This is your bigger resistance above. This could be a support area. Utilities made new highs here, holding the 9 EMA up. There is some divergence in the short term. Retail finally had some sideways movement here, but finally started pushing last week. 200-day moving average right here to monitor. Here is consumer staples. Pull back to the 20 EMA for now. Industrials, very strong with the major indexes. Holding the 9 EMA, that's your critical short-term support. XLE Energy, this is, energy, oil and energy stocks. I'm continuing to monitor the higher lows that have been formed here. So if you're long this, I'd put a stop at the higher low here. Still looks decent here if it can take out this high. Oil services, same deal. If you're long here, I'd be having a stop at the higher low there. That's a simple guide for swing stops, guys. Use the previous higher lows and move your stop progressively to the higher lows. Here's biotech. That was the strongest sector last week. Still looks very good here. No MACD divergence here at this point. Next, let's move a few market or world indexes. Here's the German DAX. 2 weeks ago, I said this looked like an inverse head and shoulder pattern. You can see it here. Falling wedge, MACD divergence, right shoulder. Guys, as an education, falling wedge patterns often morph into inverse head and shoulder patterns. They go hand in hand. Anyway, this so far is playing out. I pointed that out 2 weeks ago as a long. How could you have played it? You could have played the ETF EWG, which is right here, EWG. Again, not a big move, but so far was an easy long if you bought it. Maybe 200-day moving average would be a target. Next, here's the China Shanghai Index. Was really strongly downtrending last year. I said last year if it got out of this channel, could be a long. It did that in early January. Here's some of the ETFs that mirror. If you bought this in early January, you've had a nice rally. So here's one of the ETFs, CAF. So when the index above broke out of its channel, you could have bought this right around the 19 area. Really nice percentage move. Congrats if anyone did that. Next, moving on to commodities. Here's crude oil weekly view. You put in a doji candlestick late last year. That was a low risk long with a long right over the doji high. Stop here. Notice crude oil found support at that 42 area, which was logical. Rallied all the way up for weeks here. Now finding resistance right around here. Here's a zoomed in view of the weekly view. Again, guys, when you get a nice doji candlestick like that, that can provide a low risk trigger if you have some divergence like you did on the CCI there, okay, and you had on the RSI. That was a real low risk long area. We pointed that out. Could have went long on crude oil at 47 for a nice good 20% move. Very nice percentage move. Next, here's the daily view of crude oil. Again, it is forming higher highs here, but here we drew sort of an expanding triangle to monitor. Next, gasoline. So 2 weeks ago, I pointed out that unleaded gasoline looked like an inverse head and shoulder pattern, and it actually played out. So if anyone bought that, congrats, it actually did well. Next, here's natural gas. This is at a big move, a lot of volatility, a big move up last year, big sell-off, and a nice bounce here in the short term. You can see it's moved up the last couple weeks, which we were expecting, an oversold rally. Let's move to the daily. Here's the daily view. You had that falling wedge pattern I was talking about 2 weeks ago. I said it looked like a low risk long, and it's moved up here nicely. That doesn't look like much of a move, guys, but remember, this is kind of, with this big move up here to here, this is kind of muted. This is actually a good percentage move. How would you have played that? You would have bought the triple long ETF, UGAS. You can see if you bought this around the 29 area, you've had a nice percentage move up into here. Here's a 60-minute time frame. Here's my idea of setting your stops to each successive high or low. So you had an initial stop here, moved it to here, then here. If you're aggressive with your stop, you could probably even move it right to there. So that's a way to protect your profits and allow something to run. Okay, so that's a very simple guide for those of you who swing trade. Next, moving to copper. Copper had a nice double bottom in early January. See this horizontal rectangle pattern. So one possible price target of copper over time, you could take the height of the pattern, add it to here. Could be up around the 320 area. We'll see if that manifests over time or not. This now is support. This 290 area. Next. Here's corn. I noticed corn, a lot of the ag area sold off last week. Corn, doji candlestick here. Hammer, so maybe we'll get some follow through bounce to the upside. Next, here's DBA. Notice a black candle doji here. In fact, this looks quite oversold now, guys. You could go long over this doji. Your long would be over 1650 with a stop right there at the low at 1634. So, man, that's a tight stop. You're looking at a, 17-cent stop. Very tight. Next, here's coffee, weekly view. So back last year, I pointed out a low risk long off that weekly doji, which worked out for a big trade, good 25% trade there. Now we got another weekly doji. So along here on coffee would be 102 would be a trigger with a stop at the low. Again, none of us really trade coffee futures, so play the ETF, which is this one, JO or BJO. Your long would be over the high of this doji at 36.10 would be your trigger. Next, moving to US dollar. Here's the US dollar. Had this coil pattern, rallied up, pulled back, but found support here, trying to rally up. Keep an eye on your moving average ribbon, guys. It still remains bullishly stacked. Every time the moving average ribbon has pinched, notice that, from a bullish standpoint, the dollar is rallied. See that? Every time. So the dollar is still strong in an uptrend as long as this moving average ribbon still remains bullishly stacked. And that's important, especially for commodities, but especially precious metals. The dollar rallies, that causes weakness in precious metals, which we're seeing. So let's move to that. Here's gold, down 2.5% last week. Big sell-off. We had that doji candlestick last week that marked a high, not surprised. Now we'll see where this pullback takes us. This is the bigger picture here. The bullish view could have this as a large rounded bull pattern. You could see we have 1, 2, 3, 4, 5, 6+ years. This is your major resistance. It's got to take that out to have a big long-term rally. Okay, still hasn't done that. This is your bigger support. Next, here's a daily view of gold with the moving average ribbon. So moving average ribbon was really pinched back here. That was in late November. That provided a great low risk long. You can see you also had a triangle pattern. Rallied up. Big pullback. Here I drew the dotted line to represent the higher lows. So last week we took out that higher low here. So that has my attention. We had MACD divergence, etc. So now we'll see where this goes. But that's definitely a little fly in the ointment for the bulls. Next, here's another daily view without the moving average ribbon. Again, you can see we also broke this uptrend line. Next, here's a chart of silver, weekly view. We had a double bottom back there in November. A big pullback last week, back down 4%. Next, here's the monthly view. This downtrend line is your major resistance long term. If it can clear that over time, I would be super bullish on silver. I think it could go up in the mid-20s. Okay, but until it does that, I have no interest holding silver for a big swing at this point. You have a double bottom here. That's your major long-term support. Again, resistance for the bulls. You got to take this area out. Notice all your moving averages are all basically pinching together. So energy is pent up here. Next, here's the daily view using the higher lows. We took out that higher low last week, unfortunately. But this area now, this 14, 15 area, that's a big support area. That was previous resistance. Here I had the fibs as well. You can see where those come in. Next, here's a daily view with the moving average ribbon. Okay, shows you the same thing. That's a big support right here to monitor. Next, palladium. I don't know why palladium has been so on fire, but look at this. Since August, rallied from $800 all the way to $1,550. That's a crazy move. Obviously, some sort of manufacturing causing that as well. Maybe batteries, I don't know, but I haven't looked it up, but hell of a move here. Anyway, guys, my comments here is it's going a bit parabolic now. That gets unsustainable. Many times a parabolic move, remember Bitcoin, will end without divergence. Notice you have no divergence here really. So be careful this area. In fact, if you want a lower risk short, I would monitor this area because it's setting up to some sort of blow off top in my opinion. Next, here's the weekly view. Again, look at this move. Oh, actually this is one of the palladium stocks. So, boy, look at that move. I wish I was long that entire time. Next, moving to gold stocks. Here's GDX weekly view, down 5.9% last week. Not surprised, GDX rallied all the way up basically to that big channel and it found resistance there. Okay, now we'll see what happens, how far this pullback takes it. Next, here's a daily view. Again, guys, we were very bullish on gold stocks back around this time frame in January. And of course, even here in February on this bull flag. So on this flag and on this flag, we got nice rally out of that and went out of here. But 2 weeks ago, we formed that spinning top doji candlestick here. Notice that. You also had RSI divergence and MACD divergence. That was the area to get out of Dodge. Look how far you were over the 9 EMA. So that was an area to take your profits or even short. You've pulled back here nicely now. Okay, but I am monitoring this area to see if it can find support. You got an uptrend line here. Okay, that comes in a little bit lower. And if I monitor symmetry, the largest pullback in the uptrend from September was about $2.25. So currently we've had about a $2 pullback. If this matched symmetry, this would put a target right around here, which also matches this support. So that is an area I'm going to look to see if GDX finds support and tries to rally. Next, here's a daily view with the moving average ribbon. Obviously, it's still in a bullish configuration. It got quite wide here, so even though they're coming together, they're not really pinching like they were back here. tells you how far ahead of itself the market got, or this area got. Here's a education, guys. Whenever the moving average ribbed and pinches like this, take a look at your fast stochastics, like a 10 stochastic. When that gets overbought and curls up, that's typically a low risk buy. You see that? Now the stochastic is moving down here, but it's not curling up yet. You don't have any dojis. So you don't just buy when that stochastic gets there. You want to see the ribbon pinch. Next, here's the BPGDM. That's a Renko chart of this bullish percent chart. This gave a buy signal on November 29th. GDX was 19. So that's given a really nice trade. But even with the pullback, this hasn't even pulled back. Remember, this Renko chart can lag. It can ignore a lot of noise, obviously. So it's good and bad in my opinion. Next, as far as some individual stocks, guys, again, I'm mainly going to be monitoring the GDX. I'll be monitoring that uptrend line and that area to see if we find support and the symmetry. But obviously a lot of the individual stocks have pulled back, so I hope you took your profits a couple weeks ago on those dojis. You know, here's a couple of them. Again, AEM, this is still holding its uptrend fairly well here. It's higher lows. You know, gonna just see where it goes. Let's see. Oop. Here's AG, silver stock. This had a nice breakout, but it's pulled all the way back now to support. And Argo, another one of these, it's pulled back quite nicely. Here you can see that low risk buy in January when the moving averages pinched together. Your stochastics got oversold. That's a very good guide that I like to use for things. All right, guys, that does it. This newsletter is about an hour long. I know it's quite long, but I hope you appreciate it. These videos are actually much, much harder to do than our standard newsletters. The files tend to be very big. We got to upload them, and that takes a long time. So, you know, hope you appreciate me taking the time to do the video because, again, it's not something we're going to do very often because it's difficult. Again, we'll see what happens this week. Again, just to recap on the major markets, you know, I'm going to see if we do put in another push early this week. I'll be looking for a possible high. I believe we're pretty close now. It is possible we already put one in. Monitor the VIX. The VIX is at the lower Bollinger Bands. That has my attention. Okay. Coffee, remember coffee has a big weekly doji candlestick. I think you might be able to get a low risk long area there, maybe some of those ag areas. Precious metals are in a correction, the stocks especially. I will be monitoring their pullback, especially GDX. All right, guys, that'll do it. That's a wrap. Have a good evening. Take care.